invoice discounting. I've already brushed on this a little bit. It's a bank product. Now, banks come in and out of this product every day of the week. ANZ was in, they give it to Allianz, they move out of the space, now they're coming back in. Commonwealth still do it, Westpac still do it, ANZ still do it. I think CBA moved away from it. BOQ are doing it, Bendigo, Liberty I think is another bank that does it. Basically the bottom line is invoice discounting is for big business. If you're turning over $2 or $3 million and above, then invoice discounting is your product. It's not micromanaged well, so your back-end structures and facilities have to be awesome in order for you to get this product and ascertain it. Now, normally the fees, because banks don't pay interest, they don't borrow money, they've got their own money, and their interest rates are between 7 and 9%. So normally with a bank product, instead of charging you a percentage fee, they normally round it off and make it a dollar amount. So perfect example, if you've got a $5 million business, they would probably charge you about $1,000 to $1,500 fixed fee each month, with your interest on top of what you draw down. And what business wouldn't like that opportunity? Now, most invoice discounting products are highly confidential, so the only downside to the confidentiality is that if they feel they're exposed or a debtor goes bust on you or anything, they can disclose the facility to exit, and that can cause a lot of problems if debtors don't know what's going on. Confidential factoring. Now this is exactly like full service. All the charges, all the fees are on the full invoice value. The confidential part of it is normally meant because it can be selective and no lock-in, and as long as you put up an asset to the value of what you're borrowing, you can get a confidential facility and you can use it and walk away from it or come back in 2 months. Now, the asset itself is the important part, because a lot of the times these lenders, as I've said to you, if you put the risk in the lender, they're going to ask for this sort of stuff. Now, if you have so you get an understanding of how the facility works, you need to factor 50 or 100 grand every 2 months, 50 grand a month. So you're going to have 100 grand out the door. You'd want at least 150,000 in equity in your home to be able to do that. Now, I know it's a bit of a risk putting your house up, but in some cases the confidentiality is more important, because the industries are so tight and they don't want to know, the opposition don't need to know that you're debtor financing, because as soon as they get a whiff of that, they'll go around and steal your business and all this other stuff. But 9 times out of 10, construction, one-on-one clients that just want that extra bit of comfort, take this sort of product. Now this again ranges between 2 to 3% for 30 days and goes up to probably 5-6% to 60. So if you range about 3% a month, you're on track. Partnership factoring. Normally a 12-month product, but it's a lot better than full service factoring, and I'll explain why. The same sort of principles apply. You send all your invoicing in, you're allowed to take up to 80%. But it's more like an overdraft. With full service factoring, what happens is that you get 80% of those invoices put into your bank each month, because you're paying 3% on the total invoice value. With partnership factoring, their fee structure is totally different. Let's say you had the $1 million revenue. They might say to you, we're going to charge you 2% as a service fee. So straight away, you know that you're going to be costing you $20,000 a year. Now, if we make it easier and make it 24, well, you know straight away it's costing you $2,000 a month. And as you put in your normal factoring, and they charge that service fee against those invoicing, it's $2,000 a month is coming out as your service fee. The other way was $3,000 or plus. Now, the interesting part, which makes it very affordable, is you get to govern when you're drawing down that money. So, for instance, you've put $100,000 worth of invoicing into the client, into the lender, and the lender says, well done, you've got $80,000 available. Now, in the first week of the month, if you didn't need to draw it down, you're not paying any interest on it. But then the next week, you might say, oh, I only need $20,000 to take care of wages. Now, this is where it really becomes cheaper, because you take the $20,000 and you're paying a per annum interest rate. Now, let's say, for instance, it's between 11 and 12.5%. If it was 12, that's 1% a month. So that 1% per month on what you draw down. So with the full service, if you had any overdue invoicing, they're charging you an interest rate on the invoice value. You can see now how partnership is governed by you and can be 2/3 cheaper than what they're offering. Now, there are some downsides to partnership. They obviously monitor your exposures a lot more. They can limit debtors down in their advances. Normally partnership, because it's so much cheaper than full service, it's monitored by a computer and not so much a human. But in most cases, they're email, they're online, they're very simple to understand, and at least 70 or 80% of businesses out there fall into a partnership facility. Unless, like I said previously, in full service, you just can't. Trade Debtor Finance Consultants was created by a husband and wife team nearly 5 years ago. At the time, there was a real industry need for businesses to get a better understanding about factoring, debtor finance, and invoice discounting. Since then, they have signed up over 300 clients. The business continues to develop new lenders with new products. And in Australia, there is over 45 lenders to choose from. Trade Debtor Finance Consultants, or TDFC for short, supports 22 of them. Those lenders we respect. We know their ins and outs, their back ends, their contracts, and when we provide them to a client, we have a great understanding of what's going to happen, and there should be nothing jumping out of the closet. Trade Debtor Finance Consultants actually provides each business on their interview, whether it be phone or in person, a written obligation-free quote, and in most cases up to 4 options to choose from. So owners can sit back after they've given all their information and interview particular lenders and not be wooed by a salesman. Because TDFC provides, at most times, the questions needed so that they can get a better understanding of the product, its contract term, its fees that's been presented to them. Now, not only do we help clients find facilities, we actually offer clients a free online support for the life of the loan chosen. This is so that clients don't get angry at lenders. They can use TDFC as a third party, and we can get to the bottom of what is going on and how it can be fixed. TDFC is here to help business better understand factoring, debtor finance, and invoice discounting. And if you don't believe us, then go to all of our referrals that are on our website.
Don't forget to click the link in the description for more information on this product.